Can you educate us on the NVIDIA bear call spreads now? Thank you. Okay, I mean, well, first you need to pick strikes. Like 300, 305 looked very promising, right? So let's use these two strikes as an example. You sell this, so you're selling a $300 call, and you're buying a 305. And this is a bear call spread. So the profitability in this position is that the stock trades under or just at like $300, right? So you don't want your sold strike to go in the money. And then the risk protection here is that if the price goes up, your maximum risk is the spread here, right? Which is $500. That's $5 times 100. To hedge these, there's a few options. One, you can take your now you open this position for a net credit. So if a large upside move is imminent, or already happening, you can buy an additional call at your bought to open strike or after it if need be. Like say Nvidia hit 309 and it's still ramping, right? You can buy like a 310 or a 312 or 312.50, I guess it is. And you can capture any additional upside, and then any profitability here, you'll be able to narrow that spread by however much you make off of the additional call, right? So if this call makes $5, its premium increases by $5, then you've covered the risk from here, and then any additional increase in the premium is profit. Generally speaking, when I have bear call spreads open, I'll open as it approaches my sold strike, I'll open a call here at like 300. And this hedges any. This is what I did this week. When it started to approach like 297, I started buying calls at my sold strikes. And so this way, any profitability within your spread and above your spread is covered by the call. So you can sell the call, and then that eliminates the risk of any higher price. If you think the underlying is going to continue rising into the future, you can like sell a CSP here and create like a synthetic long on wider spreads. Like say this is like 320 and you have a max risk of $2,000, you can collapse the spread. And this is something that came up recently with someone in the pickle jar. And to do that, what you can do is you can sell an in the money spread, right? So you could sell like a 280. Let's put these on opposite sides. So buy, sell. So you could sell it like a 280, 285 position, and this will provide a net credit. But its risk is already baked in because it's in the money, right? So you can sell this position and then open a $300 call, right? And then any upside move that is captured, you can sell this, right? And then you've effectively collapsed the risk on the entire position to 500, which is the max risk here. Because now, at the end of the day, these strikes are the same, right? This works better when early assignment isn't on the table. So this is always better on like SPX or XSP, like European style options. This option is far better. But yeah, you can collapse the spread, and then your profitability becomes whatever the 320 call can gain in premium value. So if this runs to, like let's say this runs to 335 and your profitability on your 320 strike is 1500, minus your max risk, which is now 500, leaves you $1,000 profit on what was initially a bearish position, right? How dare you kiss and tell? You love me. Don't lie. If you're buying a call at the same strike as you sold your call, are you doing that at a different expiration date? You can, but no, you don't have to because you're gonna sell that extra call for profit. So like this week I bought weeklies, right? I bought weeklies on all my NVIDIA spreads, and then I sold them at like 315, and the profit from the weeklies I bought protects the spread. But I also made money on top of it, right? Because it ran beyond my strike. Otherwise, yes, you'd just be buying it back. But if it runs beyond your strike, you have profitability. So you'd want to do that while the 300C premium is 5 or less. Yeah. Is it good to play XSP in place of SPX for smaller ports? Are there disadvantages to this? I mean, it's not very liquid. I don't really know how much risk management strategy is, and I think he outlines some. It's been a while since I've read the book, but I didn't pay attention to any of them. I think he has there's like a section on risk management. I mean, there are risk management strategies throughout the book. It's about options. Color Jemson, this might sound crazy. Are you doing a meme? Are you doing a bit right now?